Hi guys. Today we will analyze Procter & Gamble stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. Also recent evolutions are not that positive. The short-term trend is negative, the long-term trend is neutral. Not much exciting is going on here. Strong support levels are around $139 and $135. Next strong support levels are around $130 and $122. Strong resistance levels are around $145 and $157. Next strong resistance levels are around $161 and $165. In the last month the stock has been trading between $139 and $163 range, which is wide. It is currently trading near the lows of this range. The stock has an average volume of 8 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth. Even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 4% per year, for last 5 years. We see that the average profit margin of the stock has been around 15% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 145% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Procter & Gamble Company: bad, average, and good. First scenario. Procter & Gamble will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 2%. Future profit margin would be low, 13%. Future free cash flow to net income rate would be low, 80%. In this case, the fair value of the stock today would be $116. Second scenario. Procter & Gamble will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 3%. Future profit margin would be average, 14%. Future free cash flow to net income rate would be average, 85%. In this case, the fair value of the stock today would be $137. Third scenario. Procter & Gamble will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 4%. Future profit margin would be high, 15%. Future free cash flow to net income rate would be high, 90%. In this case, the fair value of the stock today would be $161. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 5.72. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Procter & Gamble, analysts forecast growth rate around 5% per year in next 5 years, and future P/E around 24. Again, I will use 3 different scenarios for Procter & Gamble Company: bad, average, and good. First scenario. Procter & Gamble will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 2%. Future P/E would be low, 20. In this case, the fair value of the stock today would be $58. Second scenario. Procter & Gamble will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 3%. Future PE would be average, 22. In this case, the fair value of the stock today would be $70. Third scenario. Procter & Gamble will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 4%. Future PE would be high, 24. In this case, the fair value of the stock today would be $83. As you can see, today the stock is overvalued, $141, even if we expect the company's high performance in future. The company has a good profitability rating, but there are some minor concerns on its financial health. Also, the company is expected to show a very small growth in the next 5 years. Based on that, the stock looks overpriced at the moment. Procter & Gamble is a dividend king. So, I may consider buying the stock for the dividend, when the stock drops below $115. Company's strengths. The Procter & Gamble Company is an American multinational consumer goods corporation. It manufactures daily use household, personal care, food and paper products, and sells it in over 180 countries. The company's major brands include Tide, Gillette, Pampers, Bounty, Crest, Oral-B, Tampax, Charmin and other. Approximately 47% of sales are from North America. This is a genuinely strong company with good operating margins, excellent debt coverage and 131 years of paying a dividend. The company has A credit ratings, which allow access to the commercial paper markets, in even the most difficult market environments. The company will continue to benefit from increased attention to health and hygiene. Long-term earnings and share price gains will be driven more by product innovation, productivity improvements, and better advertising. The company is valued for its recession-resistant business model, reliable dividend, and strong balance sheet. Shareholders can benefit from the defensive nature of the stock. The company's return on assets of 12%, return on equity of 32% and profit margin of 18% are amongst the best returns of the industry. The company is a dividend king. It has raised its dividend for impressive 65 consecutive years. The stock currently has 2.58% dividend yield. Risks. Inflation and softer economic conditions may lead some people to trade down to store brands. A consequence of the pandemic is that companies are facing higher raw material and shipping costs. Higher food and fuel prices could cause shoppers to adjust their spending. Additional potential headwinds are significant currency weakness and geopolitical disruptions. Procter & Gamble's greatest risk is competition and the maturity of its brands. The company's substantial investment in new products, such as Tide Pods, may also hurt results if these items fail to gain traction with consumers. The Gillette division has seen some competitive pressure, as some consumers may shave less often while working from home, and generally spending more time at home. Disruption to travel retail from lockdown measures around the world has plagued the company's beauty segment. These challenges may persist, as long as mobility restrictions are in place. After 3 strong fiscal years, growth rates were rather disappointing for Procter & Gamble in the first quarter of fiscal 2022. Growth also slowed down for several years, and nobody knows if Procter & Gamble will be able to grow with a similar high pace as before. The company is not financially healthy enough and could expect problems in meeting its short-term obligations. Based on estimates for the next 5 years, Procter & Gamble will show a very small growth in revenue. The revenue will grow by 4 to 5% on average per year. The earnings per share is expected to grow by 7% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.